The big theme today in the markets, Donald Trump and his pressure on the Federal Reserve. But AI has been the big theme over the past year and more. Gold surging with uncertainty over U.S. monetary policy. Let's get more on how you could navigate this uncertainty. We're joined by Bipan Rai, head of ETF Alternatives Strategy at BMO Global Asset Management. It's great to see you, Bipan. Thanks very much indeed for joining us.
It's great to see you as well, Andrew.
Straight off, though, did you ever think you'd see something like this, a U.S. Government threatening to prosecute the head of the Federal Reserve?
Well, no. This is we're in uncharted waters insofar as the Federal Reserve is concerned. I mean, certainly you can point back to prior instances where we had a certain degree of palpable tension between the White House and the Federal Reserve. I mean, that's primarily a story from the 1970s, and of course, we remember that era for being notable for high levels of inflation and the like. And that's something that a lot of investors should think about in this sort of next era for monetary policy making in the United States. To what extent does that lead to unfavorable outcomes for the real economy?
And interesting, I thought that Tiff Macklem, the governor of the Bank of Canada, issuing a statement in support of Jay Powell. You'd think he must have considered, well, I'm just going to steer clear of that. It's an internal American thing.
I mean, if you look back across the last several decades, and certainly across the span of developed market economies, I mean, the Great Moderation, part of the reason why it was so successful in taming inflation was the fact that central banks made it a focus. And for central banks really to prioritize inflation and getting it down to more reasonable target levels, I mean, that requires a degree of operational independence from the fiscal side of things, and really moving away from that fiscally dominant era of monetary policy making that had been a few countries had been subject to that in decades past. So again, this is sort of the notion of an independent central bank. It's not a U.S. specific value. This is something that's quite common across most of the developed world as well.
Now, you have some ideas, ETF ideas. They are BMO ideas, but, we'll note that, for navigating the current market. You say that there is possibly a rotation going on from AI, but one option for people who want to keep a toe in the water here would be the Canadian, the BMO Covered Call Technology ETF, ZWT. Why is that?
Right. So we feel that, if we're looking at the AI space going forward, I mean, it still makes sense to be invested in the space. And I mean, sure, you can have this sort of talk about, AI being a bubble. In fact, we would argue that, it's moving away from being a pure beta play, whereas anybody investing in the space automatically, you'd expect their shares to increase. We think there's going to be more winners and losers going forward when it comes to capital expenditures and deployment of said capital in the AI space. It's a lot of the winners and losers, and what happens going forward from here is going to be dependent on, one, how that capital expenditure is financed. Is it, again, financed endogenously from operating cash flows, or is it reliant on external debt financing? And then two, it's also going to matter what the capital structure or the makeup is for a lot of these firms. So again, there's going to be winners and losers. And in that sort of environment where, say, pure beta takes a back seat to more active strategies, we think there's room for covered call strategies that target the tech sector to potentially outperform while allowing investors to harvest a reasonably attractive yield as well.
Now, my Bloomberg screen is showing that I think this thing was launched in early 2021, and it's done pretty well. Total return of 150% in Canadian dollar terms, actually beating the NASDAQ 100. So often, you give an upside here, but it has, by my Bloomberg screen anyway, beaten the NASDAQ 100 over that period.
It has. And we can't look past the fact that we also do harvest a reasonably attractive yield as well, that it is also adding towards that the return profile for prices alone. So we do think that is also something that is important. And again, it's really the composition and the structure of that particular ETF. And that, again, we have to attribute to our top-notch portfolio management team.
Yeah, I was including the distributions there. Now, on Canada, we're going to face trouble. The Prime Minister said we were going to go elbows up, but we've backed down from a lot of the measures and dropped the digital services tax, trying to please Mr. Trump. So it could be choppy for Canadian stocks this year. You have a product, ZLSC, the BMO Long
Yes.
Short Canadian Equity ETF. What's that one about?
So that's an ETF that has done reasonably well over the past year, and that's leveraging our abilities on the quant side to put up particular, say, frameworks or lenses with which to filter through Canadian or the universe of Canadian stocks and pick winners and losers. And again, there's
Did we lose Bipan there, or is it me? Oh, sorry. Go on, Bipan.
I'm sorry. No, it's one of those screens where we, or at least one of those strategies where we tend to leverage, our intellect within BMO Global Asset Management, insofar as quants are concerned, and really optimizing strategies that filter through particular screens. And again, it tends to do reasonably well during an up year for the broader index, which is something that we saw for the TSX in 2025. Certainly something that we're expecting again in 2026. And again, this particular ETF should do well under those circumstances.
We're tight for time. You have another product, the BMO Covered Call Spread Gold Bullion ETF. What's the idea with this one?
Well, I mean, in this sort of backdrop where we're in this sort of space where we are a little bit leery about fixed income and the fact that it could correlate positively with equities more and more, again, if inflation remains elevated, we like holding gold as that instrument that is, a diversifier within the portfolio. It can mitigate some of the volatility. Now, of course, the long-term problem with gold is the fact that it yields nothing. So, again, if we have this covered call spread, and again, this is very different than a covered call strategy, this allows investors to participate one-to-one with the movement in gold while also harvesting in yield as well. So it does bridge that gap between something that gold has been missing as a diversifier versus traditional diversifiers like fixed income. And that's something that we think should appeal to a lot of investors in Canada. Now,
I believe you just launched that one in May of last year, Bipan. It has over that period underperformed, but of course it's been gangbusters for the gold stocks. I'm showing a total return of about 33% for that ETF since the end of May of last year, whereas the XGD, a straightforward iShares ETF, is up almost 90%. So it has lagged over that period.
It has. I mean, it's also a function of the fact that gold prices have done extremely well over the past year. Now, if you're somebody who's sitting there and worried about the fact that gold is incredibly overbought, and certainly you can make a reasonable case there. I mean, certainly, the diversification appeal of it will still remain there, but that is offset if we do see a meaningful retracement in gold prices in 2026. Something like a ZWGD should shelter investor portfolios from that, given the fact that you still do harvest an attractive yield. So again, if we're having this conversation from, say, 10 to 11 months from now, Andrew, wouldn't surprise me at all if we have ZWGD that's outperformed.
That's interesting. And, you gave us a new ETF angle there, Bipan. I really appreciate it.
My pleasure.
Bipan Rai, head of ETF Alternative Strategy at BMO Global Asset Management.